I'm about to show you a MACD strategy which is very easy to use, works in every market, no matter what market you are trading in, and will make you money. So without wasting any time, let's get started. MACD, or the Moving Average Convergence Divergence, is the most popular technical indicators used by traders. Almost every trader knows about this indicator, and most of them use it for taking trades. This indicator mainly uses moving averages to find trends in the market and give sell and buy signals. But the MACD indicator by itself is just okay-ish in generating high-quality signals. So, make sure you watch this full video till end to see how I pair it with some other indicators to make it perform from mediocre to absolutely insane by optimizing the strategy. First of all, let's add the MACD indicator to our chart. To do so, you should go to TradingView or whatever chart website you prefer, and then get into here to the Indicators tab. Type in MACD and click this top one. Now that we have the MACD indicator added, let's understand how it works. The MACD is made up of 4 different components: the MACD line, the signal line, the histogram, and the zero line. The MACD line, which is the blue line, is set to 12-day moving average by default. The signal line, which is the orange line, is set to 26-day moving average by default. Then we have the histogram, which represents the difference between the MACD line and the signal line, which means smaller the space between the two lines. The smaller the histogram gets, the bigger the space, the bigger it gets. When the MACD line is above the signal line, the histogram stays green. And if the MACD line crosses below the signal line, then it turns red. And finally, we have the zero line, which basically represents the center of the MACD indicator. Now we know all about the MACD, let's talk that how to use it correctly. The MACD indicator is insanely good at finding trends and markets. You can tell the market is in an upward trend by looking at the cross upwards between the MACD line and the signal line. For example, here the MACD crosses above the signal line, indicating the chart is in an upward momentum, and here the MACD crosses below the signal line, showing downward momentum. Histogram can also be used to get the idea that how much momentum is actually there. If the histogram is getting bigger, that means there is an increase in momentum, and if it is getting smaller, then there's a decrease in momentum. When the line crosses upwards, but only if they cross below the zero line, then you can enter in long trade, and when it is above the zero line, then you ignore the signal. Same concept apply for the short. You only enter a short trade if the lines are crossing downward and above the zero line. So, as you can see just by watching, this indicator is very easy to use, but the problem most traders face is that they only use this indicator alone without any other confirmation. MACD indicator works extremely well if the market is in a trend. So for example here, the MACD indicator is doing a great job indicating when the price is about to move upward because the chart is in upward trend, but here the price is in a downward trend, but the MACD is still signaling to buy long even though the price is going down. If we're trading long, we should only trade if the market is in an uptrend. And you should never trade against the trend because trend is your friend. So an easy way to figure out if the market is in an uptrend is just add a 50 or 200-day moving average. Both the moving averages work equally well, but we're using 200 EMA in this strategy because it is what most traders use. To do so, just go to the Indicators tab on TradingView and type in EMA, which stands for Exponential Moving Average. Select the first one, then click the settings of the EMA, go to Inputs and change the length to 200, which make it a 200 exponential moving average, then go to Style and change the color and thickness according to your liking. After adding EMA to your chart, you see just a line showing average price of previous 200 candles. This video is about MACD, so we will talk about moving averages briefly in another video. Just remember the thing that if the price is above that line, the market is in uptrend, and if the price is below that line, the market is in a downtrend. So we only take long in uptrend and short in the downtrend. We're going long. So all we have to do is put it all together. We buy if the MACD line crosses below the zero line mark and the current price also is above the 200-day moving average. This will make sure that you are only trading when the market is in an uptrend, which is a very powerful combination. If you want to short, then you should do the exact opposite, which means the price is below the 200-day moving average and the MACD lines are crossing downward above the zero line. As an example, we can enter a long trade right here. Because the MACD lines are crossing upwards below the zero line, the current price is above the 200-day moving average. And put stop loss below the 200 EMA as it acts as dynamic support and protect the stop loss. I like to have a 1 to 2 risk-reward ratio. For this example, the strategy worked as we expected it to and we made money. But we can further optimize trading strategy. As if there's a lot of price movement or when the chart starts going sideways and losing momentum, then the strategy starts to give false signals. So, as you can see here, the chart is moving sideways and lost almost all of its downward momentum. And the MACD gave a lot of false signals. If you trade in the market like this, then you can easily lose money. The solution for this is that we have to combine the MACD with price action. To do so, mark key support and resistance areas where the price could possibly hit and bounce. Here you can see the price hits this point and reverses. The next step is to wait for that price to go to the same key level again. And once it does that, we can expect price to bounce off the level and go in the other direction. But because we have drawn the area on the chart does not mean that it will always bounce off. Or if the area held in past, does not guarantee that it will hold in the future. If it has enough momentum, then we have to make sure that the price is about to change its momentum. That's when we bring out the MACD indicator. So what you do is make sure the price is above the 200-day moving average. Once the price hits the support made an uptrend, wait for the lines on the MACD to cross below the zero level before entering the trade. You can also use the histogram to see if the momentum is slowing down when the price reaches the key area, just for extra confirmation. But always remember to follow the proper risk management, as that is what always saves you. I have disclosed this for free that how the MACD, 200 EMA and support and resistance levels combined results in high win rate with this strategy. So all I ask from you is like on this video. I am going to reveal another max strategy with even higher win rate. So subscribe if you don't want to miss that video and many others. I hope you enjoyed this video and learned something valuable. See you guys in the next video.